welcome. We're going to build upon Brittany's presentation today, and we have some great speakers for you today. If you wouldn't mind taking a minute to introduce yourself, Dave, and then we'll get to you, Mike.
Sure. Yeah, sure. Hi, good morning, everyone. I'm David Hankus. I'm a senior principal at Technomic. Technomic is a restaurant and food service research, data, and consulting company.
And good morning, everyone. My name's Mike Culp. I'm a Taco Bell, KFC, Sonic, and Arby's franchisee based out of Kansas City.
Mike, you and I have known each other for a number of years, and I knew Mike when. Mike's over 1,000 units today, but my claim to fame, knew him back when he had 20 or 30.
Yeah, and brown hair.
Yeah, and brown hair. So to start our session off, we're just going to take a few minutes. Dave and his firm have done some excellent research about kind of that consumer and employee value experience reset. So Dave's going to take us through some of that information just to lay a little bit of foundation and groundwork for us to have a discussion. So Dave, I'm going to turn it to you.
Yeah, thanks, Gary. And so, as I mentioned, Technomic does a lot of work with consumers, with restaurant operators. And so while I'm going to be taking this sort of through the lens of the restaurant industry, I think a lot of what we're going to be talking about is applicable to just about any type of franchisee. And so I want to just start talking about the consumer first, right? Because the consumer really drives everything that all of us in the room do. And there's no question that as we look right now at where the consumer's heads are at, where their confidence levels are at, it's pretty low, right? And so we use a conference board. Consumer confidence in February was 91.2. You may say, well, what does that mean? We use that more directionally compared to everything else. And I think, the trend line is what's important. And if you look over the last several years, the consumers have gotten less and less confident about their own situation, about the economy. I think today, as we sit here with gas prices, war in the Middle East, tariffs, there's a lot of things weighing on the consumer. And what that ultimately does is impact their ability and willingness to spend, especially on discretionary items. And in my case, when we're tracking restaurants, that's certainly one of the big things. And I think importantly, if you look at the average last year, consumers are even less confident than they were during the pandemic. And so we are in a situation where the consumer's not feeling great about themselves. What that's meant for our industry, the restaurant industry, and I'm sure you're seeing this if you're not in the industry in a lot of other ways, is that traffic is down. Now, typically when we track restaurants and traffic, QSR, quick service restaurants, tend to outperform, especially when consumers aren't feeling great about their situation because they tend to trade down or there's this impact of maybe not wanting to spend as much. But traffic across the board, you can see, and this is both full service and limited service restaurants, pretty much through the entire year 2025 was down. In fact, traffic last year was down about 1%. It was also down about 1% last year after being fairly positive the last couple of years. And so we're looking at a situation where the industry is not putting more butts in seats, so to speak. And so a lot of the growth has been driven through pricing and through more of a kind of a menu price inflation. And that's a big challenge. And the big challenge is because we've got an affordability crisis right now in restaurants and in, I think, probably the broader industry, and perhaps a lot of you outside of restaurants are seeing this as well. Historically, when we look at consumer wages and their ability to spend, consumer wages have outpaced menu inflation, right? Menu inflation right now, if you look at the government data, it's averaging around 4% plus or minus. Historically, it's about 2.5%. So historically, people have always had their wages grow faster than menu prices, and affordability wasn't really an issue. What we saw starting in about mid-22 is that prices at restaurants started to accelerate, and the fact that since then, menu price inflation has outgained wages, and the gap is not narrowed, right? Inflation continues to grow on menus. Menu prices continue to grow at a rate faster than what we're seeing for wages, and what that creates is that affordability crisis, as I mentioned. And so the challenge is that it's just gotten so expensive. And we're all, in addition to running franchises, we're all consumers in this room. I think we all see that. I see it. I've got a family of 5. It costs a lot of money to go out and eat. Now, historically, the industry, and when we look at restaurants, we look at a very high level at full service versus limited service. I think this speaks to where the consumer is at today, right? If we look back 2008, the industry was pretty split in terms of where consumers spent their dollars. It was about 54% in limited service, which includes quick service and fast casual, about 46% in full service. You've seen a pretty significant shift, right? Only about a third of spending right now is in full service. And so what this speaks to is a continued growth of fast casual, the continued relevance of quick service restaurants. And so this consumer trend toward convenience, toward faster dining, has had a significant shift in the makeup of the restaurant industry. And we forecast 5 years out as well, and we see that only continuing to happen. And so even as we're in a situation where the growth has been constrained, consumers are shifting their behavior pretty significantly, and we continue to see some changes in how they're spending relative to a sit-down experience versus more of a fast or limited service, quick service type experience. And you may all know this, and you know, we're here to talk more about consumers and employees, but this is a big part of what's happening in restaurants, and I think the broader industry right now is margins are compressing. Between food costs, labor costs, as I'm going to talk about in a minute, all of these things are impacting. This is from the National Restaurant Association. It shows median pre-tax income for both full-service restaurants and limited service restaurants in 2019 and then last year. And so if you're a full-service restaurant and you're a $3 million full-service restaurant, you're basically making $84,000 annually. And what it shows is that to make any money in the restaurant business, obviously franchising, opening more than one location, really building a series of locations is where the money is going to be made. And so the independent restaurant in particular has really been challenged over the last, call it 3-4 years, as it's gotten harder and harder. And I've said publicly that it is harder than ever for a restaurant, an independent restaurant especially, to run profitably in today's environment. Now let's talk a little bit about labor and what's happening with labor. The labor pool trends are not in the industry's favor. Used to be, I've been doing this 30 years, it used to be that we could kind of assume that the population was going to grow about 1% a year, meaning you kind of had a built-in 1% growth rate, at least at an industry level, right? If you go back to the 2000s and even into the 90s, population was growing. You've seen that started to slow since 2010, you know, the average growth of population. Now, that's certainly driven by some of the things going on with immigration, lower birth rates, a lot of things that are impacting that. But I think looking ahead, what I'm most concerned about is that over the next 5 years, population is going to essentially be flat. The population is only expected to grow about 0.2%, and the younger consumers, those under 65, is only 0.1. The other thing that is very worrying to me from a labor perspective is that the participation rate continues to go down, right? So fewer people, even as the population slows, are actually in the workforce. What does that mean? It means it's harder for any of us, restaurants or otherwise, to find people because more of them are outside the labor force. And I think particularly worrying is that bottom line there, the ages 16 to 19. Where do you get your first experience at any type of job, restaurant, otherwise? You get it typically as a teenager, and you see that participation rate by those younger consumers has just plummeted. Now, is it overscheduling? Is it academic pressures? Is there a safety issue in restaurants? A lot of different things, but certainly that is creating a lot more competition that I think we'll talk about in our panel in terms of just trying to find the people that are going to work in the restaurant. At the same time, we're getting older, right? So if you look at Census Bureau projections, right now about 18% of the population is 65 plus. By 2030, every baby boomer is going to be over 65. And you see that percentage continue to grow. I know everybody loves talking about Gen Z and the younger consumer, and they're still a big part of the economy, right? They're almost 40%, but they're going down. And because of that lower growth rate that I talked about, the population under 30 continues to go down. And so we're in a situation where you know, we're sort of increasingly older and younger. Everybody wants that younger consumer, but we've been counseling our clients to really don't forget about that older population as well. But there's no question when you look at that sweet spot, right? Our data would indicate that the sweet spot for using restaurants is sort of between 27, 28, and maybe 34, 35. That's when consumers are using restaurants more frequently. So there's no question that people in that age group are going to be coming more often, but given the challenges that we've had with employment and with income growth and all of that.
Mike, so I'm looking at Dave's information there, and from your vantage point, you're operating over 1,000 units. Biggest shift you've seen in consumer expectations over the last 12 or 24 months. What caught you off guard? Where's the biggest shift in the value proposition going on that franchisees can learn from?
Well, I think there's a lot of them. I'd say the first one is obvious, and it was a big part of what we heard this morning in the keynote presentation, which is that I think tolerance for a poor consumer experience today is probably at the highest I've ever seen it. And it makes sense, right? Most of the QSR restaurants in America have a high index against the low-end consumer. That consumer, both on a percentage basis and just on an absolute basis, is as pinched as they've ever been. And when making a choice to use those discretionary dollars at a restaurant, if things don't go well, I think their reaction to that's at a very, very heightened level. I think, which is probably all obvious stuff. I think what's been surprising to me is, and we've seen brands that we're in figure this out and do really well with this, and brands that we're in still trying to figure this out. But typically in pressured macroeconomic times, you see QSR revert to value wars, and everyone races to the bottom of the price value leadership equation. And that's, I think, why historically you've seen the trend toward QSR in pressured macro times. Right.
Yeah.
What's interesting right now is that if you look at the top 60 restaurants across casual and QSR, those that are just racing to the bottom of the price value leadership equation aren't those that you're seeing at the top of the performance graphs. I think the ones who've got it figured,
in terms of AUVs growing.
Well, or just same-store sales growth or traffic growth and otherwise. I think the ones that, in fact, we did a really interesting exercise to try to get to this point with one of our franchisors where we took the top 60 the brands and we put highlights through those that we felt like were just price value leaders in their category. And we did the same with those we felt like had either abundance and or unique innovation or differentiation paired with whatever value meant to that business. And it's a very, very clear answer to what you're seeing in the marketplace. And so, at least from my perspective, this is probably the first time where I've seen brands that are figuring it out the quickest and having the most success, not just be those that are rushing to the bottom of the price value leadership, but really partnering, whatever value means in their own regard with something else.
Yeah, so whatever value means in their regard, where are they being more demanding? So they're being more demanding for that value proposition. What specifically are you seeing in your restaurants, and where maybe they might compromise a little bit?
Yeah, I think it's either abundance or premium, right? Portioning or premium that we're seeing paired with appropriate value that's being most successful. I think where people are unwilling to compromise is if you're putting a product out right now that isn't a high quality or abundant value and you're asking for anything near a premium for it.
Gotcha.
So it feels like in our world, just this sort of convergence of you've got to be unique and differentiated and you've got to have some value associated with it. And if, the biggest example of this in our industry right now is Chili's, right? People lean in on the $10.99 price point and look at the turnaround of that business over the last few years, which has been probably the greatest turnaround in restaurant history. I don't know that if you speak to their team, $10.99 plays a role, but what really plays a role is the work that they've put into the abundance of that offering, the quality of that offering, the way they've positioned it with the consumer as that it's a smart play, it's not for those who don't have money, and it's not cheap. And I think that the combination of those things in other businesses is being extremely successful as well.
Very insightful. Dave, from your research perspective, you got some consumer and employee shifts going on there. What's misunderstood right now? What's happening right now that we may not fully understand around consumers or employees? Or one of the most, maybe not misunderstood, but hey, you better watch out for this. This is the way it's going, and you need to start to kind of be aware and react to this.
Well, yeah, and I think it builds on what Mike was saying, where the price value equation, and so I think it's misunderstood that because consumers are so not confident about their situation and everything, that price is the primary driver. And what we've seen in our research is that consumers, they may be cutting back on their frequency, but they're still willing to spend when they do go out. And so their ability and willingness to spend is directly proportionate to the experience, the value, It's not just low price. And so I think what's misunderstood, listen, people love dining at restaurants. Restaurants is a form of entertainment. It's a form of socializing. There's a lot of things. And so there's a pent-up demand that I think is there. And I think when people are going to go out, and especially Chili's is a great example because they've turned the industry on its head with how quickly they've grown in an environment that is not growing. Offering that value, that experience, it's not just the price, it's having maybe a barbell strategy, but you need to understand that consumers still are going to be willing to spend when they do go out, and you've got to be ready for that and have that great experience ready for them.
Yeah, I hear you. So what you're saying there, what you're saying with Chili's, they made investments in quality, they made investments in the labor costs, okay? So these things that they've done, they're actually raising costs. So I want to talk about you're saying the margins are going down. We're saying hey, we've got to be really conscious of this value equation, which requires investments in the people and the product. Let's just shift over a little bit to the employees, because I know you got a lot of great things to say about that. In fact, I've modeled some of your development things over the years in my own company, but changes you've made to attract, retain talent in your company, because you're upskilling them, because that's part of the equation, I think. I didn't hear you say that. And do you have different roles or career paths that's changed people's performance, what's worked, what hasn't? And I know you got a lot to talk about.
Yeah, so I'm not a big believer that this environment requires you to do things different when it comes to attracting and retaining employees. I think employees have always wanted the same things. They've wanted a place that that you built a strong morale in, a place that they want to go to work in, not have to come to work in every day. I think employees want to grow themselves personally, they want to grow themselves professionally, and they want to grow themselves financially. And I think you just have to build a structure around, how do you provide that for people at a rate or at a level that the competitors around you aren't providing. I think that the restaurant business has gotten much more complicated to operate. I mean, simple things like 30, 40, 50% of your business now coming through a tablet that's on demand and giving you less predictability in terms of forecasting and projecting and all kinds of other things, as one simple example, have added extreme complexity to this industry. I think removing the barriers for restaurant leaders in particular that allow them to spend the time with the people that they're in charge of in those businesses is probably one of the biggest things you can do to unlock that morale and that environment that people want to be a part of. If you're not investing in technologies and even AI and other things to help you remove worthless, redundant work that's not going to impact either the consumer and or the experience of the employee, I think it's complicated to get an industry that's already known for its turnover to improve on those things. But I think at its highest level for us, we during periods where the business is either pressured from an earnings or a complexity perspective, we try to do what I think is the opposite of what we see a lot of businesses do. A lot of businesses say to themselves, what can we go do? What can we add to this business to try to make something happen right now? And I think our approach is the opposite, which is simple is repeatable, simple is consistent. The consumer and the employee feel, consistency matters. And we've really worked hard on narrowing the focus of like the mid and long-term investments in the business, and really focused on what are the things that we need to do really well to keep things simple at the unit level. So
habitually consistent.
Exactly. Yeah.
Fantastic. So I was intrigued by some of her thoughts around automate versus elevate, high tech versus high touch. So Dave, you see the trends here. Where's technology generally come in and really improved the customer or guest experience? Mike, where's it fallen short? Are there things that you automated that you thought you never would? And what was the impact? And how do you just balance that hospitality versus the technology that replaces it? So Dave, why don't you?
Yeah, well, I think the friction that technology can eliminate is critical, right? Things like payment and ordering is hugely critical to drive efficiencies. But I think when that's the only option, and you know, Gen Z even, you know, all our research would indicate that while they're technologically sophisticated and they're driven by tech, they still want that experience. And so I think when we talk about tech, you know, the thing that always interests me is that all of these high-tech restaurants that invest heavily, they're not necessarily pulling people out of the restaurant, right? It's not necessarily replacing people, but what it's doing is those people are being deployed to higher value activities. And so the ROI that comes from investing in technology is not necessarily in the people cost or removing the people cost. What it's doing is it's allowing those people to elevate other parts of the experience. And I think maybe that's what Brittany was speaking about, where you can use tech as a way, as a tool, to redeploy your employees to do something greater or to add more value to that consumer experience.
Rather than just using it as a tool just to cut costs or cut labor costs. So tasks, any stuff you've automated specifically that you never thought you would.
Yeah.
And then what was the impact? And what kind of decision-making process do you go through when you're thinking about that tech?
So I would say there's a lot of the obvious stuff that everyone's talking about that we've automated and are trying to automate. I'm continually impressed. As recent as yesterday, we ran an acquisition through AI and asked for it to help us with what are the key watch-outs, what questions would you ask, how would you value this business? The outcome was unbelievable. I mean, it was, I think our whole M&A team got pretty nervous pretty quickly. But on stuff I thought we never would. We're working on a technology solution right now that seems obvious, but I never thought of it, and I didn't think we'd ever be doing this, which is it's effectively a 24/7 monitor of everything that happens in a restaurant. It's listening to every conversation, it's watching every customer interaction, and then on an anonymized basis behind the scenes, it's building us, based on what we tell it we care about, a dashboard of here are the things that are the biggest barriers to customer satisfaction, here are the questions that aren't being answered well, here's the willingness of the consumer to buy an incremental product. If the question's asked this way, it's this percentage that they say yes. If it's asked this way, it goes down by this many percent. It's effectively like having a multi-unit manager watching that operation all day long, every day.
24/7.
And waking up in the morning to a dashboard that says, unit number 7 has an opportunity with these 3 things you might want to go coach against. And in the first 7 restaurants we put this in, we didn't show any dashboarding to anybody for about a month. At the end of that month, when we showed the teams the dashboards that had the outcomes of the things we were measuring against, we saw 20 and 30 and 40% jumps in behaviors that we wanted to see just by showing them the outcomes of the data. And so I think there's things like the general oversight of restaurants and the job that the multi-unit manager is out there doing today in terms of establishing issues, opportunities, et cetera, is something I didn't think we'd be doing as quickly as we are.
It almost seems to me that that's the tech that would enhance hospitality
Zero
greater than tech that you put right in front of the customer.
Absolutely.
Is that something, I'm just curious, is that something the brand initiated, or is that something?
No, I think, you know, those things in many cases make brands a little bit nervous when you think just fundamentally about a brand putting a listening device into a franchise operation, right? There's some interesting stuff there, but I think it's, you know, it's one that I think has massive legs and we're leaning into big time.
What's the one thing that consumers right now say they care about? They really care, but they really don't. Anything come to mind there? Like they say they want this, and then you go off and change some aspects of your business, and I think that's also, by the way, an interpretation of the data. A lot of times when my franchisor partner presents data to us, they interpret it completely differently than I interpret it as an operator.
I think historically what we would have said in the restaurant industry is health and wellness, right? I mean, health and wellness, just healthy items. And I think the reason that might be shifting a little bit is that, you know, healthy means something different today than it did 5 or 10 years ago. And especially with the rise of GLP-1s and the growth of, you know, just transparency and sourcing and you know, where products come from. I think people aren't necessarily looking as much at healthy as they're looking at a wholesome solution. And so, you know, I mean, sort of the joke, and I don't know, Mike, if you've seen this, but you put something, you know, called healthy on the menu and it's the kiss of death, right? It doesn't sell. But I think increasingly now consumers, as they're looking at sort of a holistic health solution, and they're looking at cutting calories, and they're looking at portion size, and they're not necessarily, they're still coming in, they're still eating, but they're eating differently, and perhaps they're more cognizant of functional benefits, of portion sizes, and of where the product comes from, and that in some way creates a health halo, if you will.
And so even in what do you foresee or see even in non-restaurant in health, wellness, and beauty? Do you see, is the demand for that
I think I was
mirroring?
Yeah, I mean, I was on a panel about a month ago with some people in the health and wellness business, and it's just booming, right? I mean, consumers are investing billions of dollars in health and wellness, but again, it's more of a holistic approach to health today than it would have been, 5 or 10 years ago. And so I think consumers generally, and the younger consumer in particular, they're cutting back on drinking. There's just some different health habits that are forming today that perhaps were different than they were when I was growing up. And so I think health and wellness is one of those things that is here to stay, but it's perhaps different than maybe what we would have thought about historically.
Yeah. How do you see it, Mike, on that health and wellness front?
I think people that really care about healthy food go to restaurants that are primarily based in healthy food. Like, I don't know a lot of people that are really, health forward that go eat, Taco Bell and KFC very often, right?
Right.
So, to me, I think it's a necessary evil to have options so that you don't become a veto vote in a car of mixed feelings. But I would agree with all of the comments that David made on that front. One thing that's really interesting to me that kind of hits on the question of what do consumers say they care about but they don't care about, is it goes back to my point earlier on sort of how you're positioning your business from a value perspective. It's always interesting to me, whether we go through a screener and we see consumers tell us, here's the price point that'll have me drive an extra mile to come try your product, or here's the product that I can just tell you I have a high intent to go try, et cetera, and here's why. And if that why is price point driven, fast forward 2 weeks later and you look at menu mix data, and oftentimes those value offerings carry the highest total check of anything that's being sold in the restaurant. And so it's always interesting to me that there's a massive disconnect in my mind between the consumer wanting to feel smart about the purchase that they're making and what their actual behavior pattern. You'd see the same in the data around the different demographic breakdowns of those who are using third-party delivery, which is by far the most expensive way to get QSR. It's not even close, right? You're, in some cases, doubling the price of the product. The same groups that tell us how critical price is to them are over-indexing on third-party delivery, right? It's like, so to me, I think it's really, this is where that marketing dynamic and really the perceptions of the brand are so critical, because they're what's driving that traffic. And at restaurant level, I think your ability to then change those behavior patterns to benefit the outcome when they're there is a big opportunity.
You talked about, like, I know it's the consumer and employee kind of reset in their thinkings, but I just want to dig a little bit more around value, okay? And what you see has really changed in the consumer or even the employee's mind in terms of value over the last 5 years. Now, we talked about the Chili's thing and the quality and price. And you talked about, our value was habitual consistency, okay? We weren't necessarily, we were making sure that whatever the hell it is we were doing really good. We weren't necessarily impacting the products. How do you guys see value that's different today that these guys need to be aware of that was different, let's just say pre-COVID 5 years ago or something?
Yeah, well, I think, one of the things that, in my presentation was about where the growth is happening, right? Because we're in an industry where traffic is flat and growth is coming from price increases, but there are winners in the industry right now. And so if you look at, we do a lot of consumer tracking and sort of understanding what consumers value and how they rate different chains. And the ones that rate for relevancy, right? I'm gonna tell my friends about it. It's culturally relevant, particularly to the younger consumer. The ones that rate innovation highly, the chains that are rated highly on innovation, and the ones that have a strong reputation or trust. Those are growing on average about 8%. So they're far exceeding the general sort of industry. And so when we talk about value, the innovation comes into play, we've talked sort of about price and where price plays, but really, those that are growing faster aren't the low price ones. They're the ones that are doing something different. And I think that is what's different today, because consumers have a lot of choices. They're dining out less. Loyalty is earned on a transaction by transaction basis, and you've got to show up every time and prove it to your consumer every time. And so, the value that you're creating is done through the menu innovation, through the service, through the experience, and all of that creates a relevancy to you that your patrons will tell others about, just like we heard Brittany talk about.
Mike, how have you seen it changed? And I just want to add, because you had some trends there that have changed a little bit. So I hear about the value, but I also wonder, is there any trend kind of going on right now that you think is like, it's just going to fade? It's just a flash in the pan. So that's not the primary question.
Yeah.
I want to hear about what your thoughts on value.
Well, I think the biggest one I would say, if your question is 5 years ago versus today, is the digital dynamic. So, our businesses are somewhere between 20 and 50% digital, meaning that the transaction is coming through a digital channel of some kind, your owned app, third-party app, kiosk, etc. And to me, there is a very different answer to the value equation when you're talking about the digital consumer, as opposed to just thinking about the brand more broadly. The competition on the digital, we've almost trained the digital consumer to open up whatever it is and flip to find the best deal that's being offered, the most assertive deal, who's spending money to push themselves to the top of the search profile on any of the aggregators, et cetera. And we do see a direct correlation between extreme or what I would call like disruptive value on digital platforms that does not necessarily translate to full funnel marketing campaigns or in-store experience. So I think the fact that 20, 30, 40, 50% of our consumers are now coming through those platforms, which in some cases has either completely eliminated or totally changed the whole idea of convenience as a winner in the marketplace. You don't any longer have to be the restaurant that's 1.4 miles away from the consumer. You just have to be a click away from the consumer. And competing for that user who's choosing brands, oftentimes on a value-driven basis, is a very different dynamic than we dealt with 5 years ago. It didn't exist, right? And so if you look at the growth in our business, our inside traffic is down meaningfully, our drive-through traffic is down, and our digital growth is double-digit every single week, year over year. Sometimes it's 20 and 30% up versus prior year.
Total shift in the value kind of equation, or
totally
delivered.
But I think you have to think about those different. I think where we found mistakes being made is when you try to follow a similar value construct digitally to what you're doing on either full funnel marketing or in-store experience.
All right, talk more about that. What lessons have you learned over the last couple years that didn't work? What did you learn from it? What maybe are the franchisees in the audience overestimating, underestimating? Like, because you just said that didn't translate well in that guest experience. So what in the last 2 years didn't work?
Well, we don't have time for that. All those.
Oh, yeah, I got it.
But
That's a whole session.
Yeah, part of your question was, what do I think people are under or overestimating?
What are the franchisees in the audience overestimating, underestimating right now about the business currently or coming in the future?
I mean, my short answer would be every discussion you're a part of, every podcast you listen to, every article you read is all about the stuff we're sitting up here talking about today. Resets and macros and value and commodities and all these things. And I think we as a company, I know many other franchisees are guilty of underestimating the impact that still being really, really good at four walls with the consumer makes in today's environment. We talked about it earlier in terms of like, are they less, are people edgier? Are they less willing to accept an underdelivered consumer experience, et cetera? The answer is certainly yes, but I think the flip side is also true, that right now people really appreciate when they've made a decision to spend their dollars with you, if you deliver on that experience, I think there's a stickiness, because in my experience at least, the industry as a whole has taken a step backwards in terms of what it's delivering to the consumer, especially on the service front, right? And so those that are standing out just a little bit, I think are getting exponential credit for doing so. I think we always try to come up with all these fancy things to go fix the problems in the business. And for us, we constantly find ourselves coming back to are we doing these 4 or 5 things really, really well? Which is why I was so excited, Gary, about the AI thing I talked about earlier, because it's given us insights as to like, when there's inflection in someone's voice, when you hit the drive-through, here's what the overall experience looks like. When there's not inflection, here's what it looks like. And so little things that just tell you like, is there a warmth about the greeting? Is there a warmth about the closing? Something as simple as that. I think those have impacts, and I think we always underestimate them.
And you and I were having a discussion earlier about, I think one of my mistakes is choosing growth over excellence. Okay, there is a balance there that, I'm going to open more units, hire more employees, get more, and your excellence suffers. And circling back to fix that, I think we both agree that we would have, in the past, leaned much heavier on excellence and been more thoughtful about our growth and less maybe indiscriminate just because the capital was available. Dave?
Well, no, and I think when you look at, we track 1,500 chains in our database, and we're seeing a huge reset in terms of those that are, what do you always hear when they're trying to kind of reestablish themselves? We're getting back to basics, right? And a lot of that has to do with the business within the 4 walls. And I think there's been a lot of concepts that have overexpanded, that have gotten, too big with bad operators. And so I think what ends up happening is if you've got a successful business within the 4 walls and your same store sales are solid and the business within those 4 walls are solid, that's a great base to grow from. But if you just start adding location on a location before you have that basis built, before you've gotten back to the basics or you're executing against those basics, then that's a recipe for disaster.
And I just think I was thinking what's the change that you're going to make now that's going to most impact your business in the next 3 to 5 years? And what I heard earlier, and I don't mean to put words in your mouth, is, look, we're going back to this quality, convenience, fast delivered, and hospitality. And by the way, we're using AI, we're using technology to increase our excellence in what we deliver. Would you agree with that? That may be some of the biggest change you're facing. Is there any other change other than that? And I don't mean to paraphrase all the things you said. I just was kind of bringing them together. But what else?
That's going to impact the next 5 years, what you're asking? Well, I think we have a lot of strategic opportunities in our own business that we need to be really focused on to make sure we continue to be successful. The marketplace is continuing more and more so to value diversification in people's portfolios. They're valuing the ability to show a sustained track record of being able to operate in multiple brands, in multiple verticals, in multiple geographies, giving yourself the choices to be able to scale in a disciplined way, and not just through the 1 or 2 things that you know. And so we've got a lot of opportunity not only to continue to do that, but also to shift our structure around a little bit to really support that. I think we've, over the years, been guilty of falling too in love with things that worked for us 5 or 7 years ago, in particular structurally. And we've learned some hard lessons in the last few years on when we've grown outside of the structure that we've put in place to be able to support it, that we're making some big shifts on. So I think the short answer is, I think we're going to continue to work on diversifying our portfolio, but making meaningful investments and changes in the way we're structured to be supported.
Just be a little bit more specific on that. I remember, forgive me, back when we were both very entrepreneurial, top-heavy, decision-maker companies. I'm still that way. You evolved into this process, behemoth. What other kind of infrastructure changes are you?
Yeah, so I'll give you 2 examples. Okay. One which is purely operationally. I think as we scaled, we really wanted the people that were really good at what they have done for a long time to continue to scale with the organization. So as we went from 100 to 200 to 500 to 800 locations, we wanted this guy who was called COO to do the same things that he'd been doing because that was his job and he was good at them. And we've learned that, I think, both as you look down the org chart from him as well as to the peer group around him, we've had to add resources to allow him to continue to focus on those things, the simpler things, and not continue to add stuff to their list over the years, which happens. And before you know it, you wake up and you're good at a few things and you're really bad at a few and you're pretty mediocre at a lot of them. And so by way of example, making the shift to dedicate leaders in each of the businesses that we operate that are the decision maker, that are the face of that brand, as one example, as compared to having a bunch of brands report up into a structure where someone's waking up trying to understand
All
five
five
marketing
of-
campaigns and five, is an example. But as another one, adding layers to our executive team that take the non-essential and critical functions of each of the leaders across our business and move those into kind of a administrative office, if you will, allowing our finance team to continue to strictly focus on being a world-class financial organization. And the same with our HR and legal and real estate and other teams. And so I think we've kind of said, listen, if we want you to be great at these fundamentals, we've got to put you in a structure that allows you to be really great at a few things.
I know we're over time. Oh, just a question on that. Process or people when you're doing that? Is it, or combination of the two? Is it processes you're putting in place to one, get the CEOs more focused and take admin tasks from the different departments, or is it people that you're bringing in to do it?
It's people, usually.
It's people.
Yeah.
So that's very interesting. That's a whole other thing in itself. Dave, take us out here on what do you see over the next 3 to 5 years, the changes, and that'll
Well,
close
yeah, I
us
think
out,
one
guys.
thing that we haven't mentioned as much, people leave bosses, they don't leave jobs necessarily. And what I want to emphasize just that we've seen is the importance of the general manager in the restaurant, but in any business. And I think, we talked earlier about Chili's. One of the things that Chili's has done really well is given all of their general managers essentially ownership over that restaurant, right? They can make decisions. There's a lot more flexibility and ownership. And so, I'd encourage you as you look at your own business to make sure that the leadership you have in each of those locations is the best, because that really, in many ways, will determine your success, is how good your general manager is.
Yeah, there's a saying that is in our business: if you have an underperforming location, after you're done blaming the weather, you blame the weather, you blame the signage, you blame the road construction, you blame the parking, you blame the competitor. After you're done blaming all those things, change the manager. We just try to do that. Ladies and gentlemen, please give thanks to our panel here for that
Thanks,
great
everybody.
information that they shared with us today. And thank you very much. Thanks, guys.